This chart shows us the return of the stock market against inflation. And if you notice, whenever this line, the line of expected return, crosses this threshold, we usually see a very big correction. So if you notice in the 20s, later in the 60s, 2000s, 2007, every time the returns have fallen outside the scope of this line, the stock market has corrected very heavily. And here we have breached this line by some magnitude. So the expectation would be that the stock market should correct very heavily over the next decade or so. The second chart that shows us a very similar picture is one of the stock market against gold. Let's take a quick look at that. This chart covers the last 30 years, and if you notice, there is an inverse proportionality between the stock price change and the price change in gold. The stock change is in blue and gold price is in orange. And if you notice, whenever we see the biggest dips in stock price, as you can see here, we see rises in gold. Similarly, when we notice gold falling, we can see the stock prices are increasing. The gold is stable, stock prices are increasing. The stock corrects, gold increases. But over the last 3 or 4 years, we've started seeing a direct proportionality between the price of gold and the price of stocks. And that does not make a lot of sense economically because gold is supposed to be a hedge against the stock market. So if the price of gold is increasing, the price of the stock market should be falling. The reason? People are buying gold to hedge their bets against the stock market. Similarly, if the stock market is rising, then gold should be falling because people have become more pro-risk. So they don't want to hedge too much and the price of gold either stabilizes or falls. Now this continuum cannot continue for too long. The simple idea is we're breaking the principles of economics. So sometime in the future, maybe 6 months down the line, 3 months down the line, or maybe tomorrow, we're going to see a major correction in one of the two assets at the very least. And if you couple this with the chart we saw first, the asset most likely to correct becomes the stock market. But it doesn't have to happen right now. The reason I say that is the third chart that I have to show you. This chart shows us the stock market over the last 30 years about, with the recessions highlighted in gray. We have 1, 2, and 3. And if you notice, before every major fall, we've had a new peak. We've had some sort of a short sell rally. What that means is too many people were short and then they were trapped, which led to this short covering rally. And again, in 2020 as well, which was supposed to be a recession that nobody saw coming, we did see one of those short-term rallies. So I don't expect that here, without seeing a major rally coming forward, and by that I mean at least a 5 to 10% rally, maybe even not new highs, but somewhere close to 25,500, I don't see the market going straight down. It could happen because we're in recessionary scenarios, and I wouldn't be buying anything new. I'd only be selling into that rally. But this is just to give you some hope that we haven't already lost the market. We might see a pullback. And this is definitely not the time to short for me. If I have short positions, I'm holding it, but I'm not going to go into new shorts.